Are you a successful IT professional and need help optimizing your compensation plan, navigating your taxes, investments, and protection? It's time to rewire and retire with Mike. Listen in as Mike gets you the answers you need to move forward. Now, on to the show with Mike.
Hello and welcome to Rewire and Retire with Mike Guarino. Mike, what's going on?
Hey, Eric, how are you, man?
I'm doing fantastic. It's that time of the year.
Yeah, yep. We're approaching Christmas rapidly, and we got some snow for Santa. That's for sure. We got like 18 inches
did you?
here.
Oh my Lord! Yeah, no thanks. I'm good.
Yeah.
Keep it. It's with snow comes Tylenol. And backaches and shoveling. I've got a snowblower, but still, it's
tweaked up my back shoveling this last weekend, so yeah, it'll get better.
Well, that's the age we're at, isn't it?
Speak for yourself.
Yes, exactly. That's right. That's the age I'm at, isn't it? That's right.
Maybe.
Yeah. All right. Well, for the audience members, we didn't come to talk about the weather, but what we did come to talk about is the second part of a two-part podcast. Mike actually started this a couple podcasts ago, 10 questions to ask financial advisors. And we got through the first 3 because those were like the kind of the thick ones. And
Right.
Mike, why don't you give the audience a kind of a review of what we talked about?
Yeah, so, the first 3 we talked about, number 1, are you an accredited investment fiduciary? Easy enough. Just, check someone's designations. If they have it, they are. If they don't, they might, and just don't advertise it. So it's important to ask that question. Number 2, quickly, how do you get paid? We talked the differences between brokerage accounts and advisory accounts. Brokerage accounts are commission-based, advisory accounts are fee-based, which fees can come out quarterly, annually, however you want to charge them. So that was the big differentiation there. And then what are my all-in costs, which I think is what a lot of people want to know. And just to recap that quickly, it's you take your advisory fee, you take any sort of account maintenance fees, you take into account the investment charges. In other words, if I have mutual funds or ETFs or things like that, what are the internal expenses of those as well? Because all those things do erode or can erode performance. So those are really important things to know, like what's my all-in number? So then you know what kind of hurdle you have to leap to, make some sort of money in the market. Between the advisory fee and the mutual fund expenses, I'm in for 1.5% or 2%. So, I need to clear that hurdle before I start making money. And that's really important for investors to know. So we're going to go into the next, what do we got? 7 beyond that, right, Eric?
Yeah.
And so I thought it would be fun because we come across these questions all the time. When we're meeting with prospects, and they want to know, and it's great. You should know, because the last thing I think a client wants or an advisor wants or any surprise is like, you didn't tell me that. So we always make sure that we address this, but I thought it would be fun today because, again, like we come across these questions all the time. It'd be fun if you could play the prospect and I could play the advisor, and
Nice.
I'll do what my brain is thinking first. I'll say what my brain is thinking first as a joke. Please, everyone understand, it's a joke. It's just to make it entertaining.
All
and
right.
then I'm going to give you the real answer. So if everybody can just indulge you and me and in that capacity, I think we could have some real fun with the podcast today.
All right. Well, then let's give this a shot. You ready?
Always.
All right. So, Mike, what are your qualifications?
I often ask myself that every day. What are my qualifications? Okay, so that was the fake answer. Now here's the real one. And again, this isn't about me. These are questions people ask advisors. So, what I would start with, and we kind of hinted at this in the first one, was look at the credentials, look at their designations, right? Like what letters that they have after their names, because that kind of tells you what the people are into. My personal belief is everyone should have an AIF. Just that's me personally. Doesn't mean if your guy or your gal doesn't have AIF as one of their designations, they're not good. It just means that's my preference. And then you look at
What's
other
AIF?
designations. Accredited investment fiduciary.
That's right.
And we it just means that we're looking out for you. We're looking out for your best interest. Which if you're not in any business, just my 2 cents, then you shouldn't be in that business if you're not looking out for other people. But that is what it is. So, I would look at things like, letters after their name. A lot of people are CFPs, certified financial planner, CHFC, CLU. I'm a CDFA on top of it. There are all these letters that don't make any sense, but if you have a specific need for a planner or a specific need for someone who handles divorce, right? Look for those credentials that pair up or match up with their name, and then you're working with the right person. As far as qualifications go, you want to look for someone who's seasoned in the business, and always ask for references. They're not, obviously when you ask for a reference, nobody's going to give you the people that are dissatisfied, right? But ask for references because it's almost like you can do like a case scenario, like I'm about to retire. So I would introduce you to people who are about to retire that I've been working with. That way you can get a good sense of if they're a good fit or not. And if a person's reluctant to give out references, I would question why strongly.
Yeah, I would too.
Yep.
All right. Well, I appreciate you answering my first question. Now I've got another one. I feel like I should have some soap opera music with this one. But Mike, how will our relationship work?
Depends on if you bring me candy before your appointments or not. I'm sorry. Wait a minute. No. So this is really important. How will the relationship work? And I always ask people this. First I'm always like, how do you want me to communicate with you? And they're like, well, I want you to call me. Well, everybody says that, but sometimes what they mean is I want you to email me. Or I want you to, actually leave messages on my phone, or, whatever modality that they're comfortable getting together with you with. That's important, and that's one of the things we kind of put in as the groundwork when we work on relationships with our clients. Not everybody wants the same thing. Some people need their hand held, and some people are like, call me if there's a problem, right? But what we do is we always make sure that we have on our calendar, right, when we meet with you, the modality, how you want to be contacted, and the frequency, how often you want to be contacted. And then on top of that, we have an obligation to sit down and review your portfolio with you at least once a year. And if you're a financial planning client, we want to visit the portfolio investments once a year and the plan once a year. So that's just how we do it here. Your financial advisors may do it differently, but that's how we do it here. So it's important to know what the client's looking for and delivering that. So it's kind of up to them. Or Eric, in our example, it's up to you. How often do you want to meet? What modality of communication do you want? And understand if you're a planning client, we're going to review that once a year. If you're an investing client, we're going to review that at least once a year.
Got it. All right. Sounds like I'm getting taken care of.
Yeah, but that doesn't mean that's all we're doing there's always a but. That doesn't mean that's all we're doing in the background, right? What I'm getting at is in the background, we're rebalancing your portfolios. This time of year, it's the end of the year. We're pairing off losses and gains to make things real tax efficient on the back end. So there's a lot of work that goes in, not to mention the countless hours of research and analytics that any good advisor is going to be doing to make sure that the portfolios are lined up with what's going on in the market and that it's relevant. So don't think just because your advisor is talking to you once a year or planning for you once a year that's all they're doing. There's so much background work that goes in every day to every portfolio, every plan, every client.
Got it. All right. I know the audience can't see us, but audience, we put a lot into this show. So currently, I now have a monocle and a top hat on for this next question. So just picture that. Monocle, top hat.
You
Ready?
look like the guy from Monopoly right now.
Shush. Yes, and I'm supposed to because of this question. Sure. Ready?
Mm-hmm.
Michael, what is your investment philosophy?
How did this guy get in the office? Oh, sorry. Well, that was what I was thinking.
The back door.
Who left that open? So now, I thought we deadbolted that. So now I'm going to give you the real answer. My investment philosophy, quite frankly, is own investments for the long term. Let's look at things and measure things long term, but let's make adjustments in the short term to make sure we're pointing your portfolio in the right direction. We've seen a lot of people make mistakes in 2008, going into 2009 when the market was crashing and they sold stuff or sold everything. We saw people make mistakes during the COVID crash, right? We'll call it that. same kind of thing. They went to cash and they hurt themselves. My job, if I'm doing it well for you, Mr. Cane and Monocle,
I got a
is
cane
to
now?
make I thought you said you look like the guy from
I got a top
Monopoly.
hat.
Oh,
Sorry.
top hat. So.
Sorry, but I'm old enough for a
put it-
cane, so keep rolling with this. Go ahead. Jeez.
So,
Michael, could you speak up for me too?
am I coming through? Okay. So, going back to the philosophy, if you're panicking and trying to get out of your investments during a market crash, and we've seen so many flash crashes, and like I said, 2008 to 2009, COVID's the most recent one. What I've noticed is the people that hung in there and just let us do our job for them, they were the people that hung in there and, had the results they were expecting in their portfolios. The people who got, over my shoulder and wanted to intervene or go to cash or whatever the technique was that they wanted to employ, I tried to get them to stand their ground. Hang on, this will pass. So a good advisor who's forward-looking, long-term oriented, I believe will give the right advice. But my philosophy is like, listen, we're in this together. This is a long-term relationship. The market's going to do what it's going to do. Understand that I have your best interest in mind, and I'm going to navigate the markets to make things as best I can for you possible. But sometimes the market throws curveballs that, make everyone, worry or panic. And you have to have that staying power, and you have to have an advisor who has that same mindset.
Yeah, and I would say that I'm going to break from the role play for just a moment because that goes right back to how will our relationship work. Bottom line is I want to work with somebody I can trust. And so therefore, I think the client has just as much responsibility in developing the relationship as you do with them. Am I wrong?
Right. No, you're exactly right. And so often we find when we meet with people that they tell us what they think we want to know. But, the more we know, the better off we can be. Because, advisors like to look at things holistically, not just one little wedge or one little piece or just one little account. Mr. and Mrs. Client, show me what your portfolio looks like. Show me what your assets look like overall. Let's talk about your goals and your plans because, I want to make sure it all augurs together, that it all works together. And that helps us manage overlap and things like where you're super concentrated. If I don't know what my clients own on the outside, how do I know how to allocate portfolios here? So you always want to make sure, and again, you hit the word trust. If they don't trust the advisor, they may be unwilling to share all their information with that advisor. But that's where the relationship comes in. And it's a thing that builds over time, like any relationship, And eventually what you'll see is clients may hold a little bit, play their cards close to their vest, but over time they'll start saying, hey, by the way, I have this CD at the bank, or this is what my 401k looks like, or I have all this stock at my company. And then we can make really, really good decisions with them once we have all the pieces on the table. So yeah, trust can delay getting that, holistic view of everything. But once you have it, it's the best thing that you can have because now I know how the puzzle's going to fit together.
Yeah. Well, audience members, if you did not hear the first podcast, please go back and listen to it because it does cover the first three questions that Mike touched on. But the main reason I want you to know about that one is because we said at the beginning of that podcast, these 10 questions are things that you want to be asking any advisor that you're considering working with. And Mike is going to do a great job on this next one of explaining why this is an important question, because from my perspective, if I'm asking this question, it's me just trying to go in there and sound smart. Which I need to know why I'm asking this question because I wouldn't think to ask this, and I don't think a lot of the audience would think to ask this. So
Eric, what question? What's the question? You're killing me.
Yeah. So Mike, what asset allocation will you use? I mean, I don't know what even that means, Mike. I mean,
and I'm thinking, here's my thought.
Yes.
Did he just read this in a book somewhere?
I did. I totally did right off a paper.
Yeah, I'll give you the 35,000-foot view. Asset allocation simply is the ratio of stocks and bonds in a portfolio. I mean, if you break it down to its bare core, that's what it is. A lot of advisors adhere to a thing called modern portfolio theory that talks about the right ratio of stocks and bonds for an investor. And that ties directly to how aggressive or conservative a portfolio is. The more equities you have in a portfolio, ideally, the more aggressive the portfolio is. The more bonds or more fixed income that you have in a portfolio, the more conservative it is. So when you ask about asset allocation, you're asking about portfolio composition. What are my ratios going to look like? And we have a really cool process that we take people through here. We use sophisticated software. Takes them about 5 minutes to use it. It's all web-based, and they get a risk number assigned to them. They assign it to themselves, basically, because by the time they get done with the whole questionnaire, it says, does this feel like you? And you click, yes, it does. And at that point, I get a number back through email that says, Eric is a 65. And that's not good or bad. That's just who Eric is on a risk level. But that risk level ties directly into your asset allocation. What am I going to make his portfolio look like? But I'm going to vet that number that you gave me as a 65 because it's very subjective. You could be going through, you could have just hit the lottery and said, oh, well, I'm a 65 because, I made all this money. This stuff that I'm going to have Mike manage or work with is, not that significant to me. So I'll be a 65. Conversely, you could, like I said, it's very subjective. You could take that risk tolerance questionnaire again and come back as a 35. So it's something that we always ping our investors on a pretty annual basis. We revisit the asset allocation and the portfolios and the results we got that year. And I'll say to them, you were a 65, Eric. Does that still feel like you? I don't know, Mike. I'll break out my laptop right in my office and we'll go through the questionnaire again because you always want to make sure that's dialed in. That's very, very important. So again, in essence, asset allocation, ratios of stocks and bonds in a portfolio, and, that has to do with how aggressive or conservative it is, and really that's the sun in the universe that advisors adhere to for their clients when they come in with that number.
Got it. All right. Well, then I've followed up with this question, obviously, because, I have to have two smart questions in a row. Mike, what investment benchmarks do you use?
Benchmarks? No. So benchmarks are pretty easy. Everybody knows like the S&P 500, the Dow Jones Industrial Average, the NASDAQ. They know the big three. So a benchmark can be a blend of things because nobody talks about the poor bond market. The bond market is just like the forgotten, thing in investing. Nobody pays attention to it. It's so sad. It's very important, by the way.
The ugly stepchild, is that what we're talking about?
I guess. I don't know.
That's terrible.
Yeah, but anyway, benchmarks are really what we talked about last time, right? Just the last question, what asset allocation are you going to use? And you would say to somebody, you're an aggressive investor, so your portfolio will be, 100% equity, and our benchmark is going to be the S&P 500. So what that does is gives them a way to compare how their investments are doing versus the S&P 500, for example. So benchmarks are very often blended, and they're blended because, going back to your example, Eric, where you're a 65, your portfolio would not be 100% equity. Your portfolio would be maybe 65% equity and 35% bonds. We would come up with a blended index of, 65% S&P 500 and 35% Barclays aggregate, which is the bond index that no one, unless you're a bond person, pays attention to. But that's important because a person who has bonds in their portfolio many times, I should say this many, it's not all the time, but most of the time, will lag in performance to someone who doesn't. And this is a general statement. This isn't the way the world works. Timing has to do with a lot of it, etc. But a person who's aggressive, for a longer period of time will probably have better results than a person who's more conservative over that same period of time. So a blended benchmark is very important to understand. To be quite honest, Eric, this question is probably the least asked question that I get. But to explain it to somebody, it's a ratio of stocks and bonds, or it can be an index all by itself, and you have something to compare your results to. That's what a benchmark really is.
Got it. All right. Mike, this next question's, I really like this one. So I'm sitting in your office looking around. It's a nice place, really clean. Who's your custodian?
When I went to Lakeview School, Mr. Moore was the custodian. Oh, wait. No.
Oh,
Hang on.
gotcha.
Custodian. Oh, our custodian. Right. So to be quite serious, this is a really important question. And why I say this is picture someone coming to your office. They park in your parking lot. They come through the front door. They're greeted by Kim. Okay, so if this is the first, lick at the lollipop here, and I'm kind of getting the feel for things here. And they come in and they meet with you, and we have a great conversation, blah, blah, blah. Everything's going really, really well. What I don't want somebody to walk out the door thinking is Mike Guarino going to take, my rollover or my assets and put it into his account? That's crazy, right? I don't want somebody to think like it's sitting in my account. So a custodian is who holds the assets. In other words, who holds the money and the investments when I move them to my advisor. And it's real easy for me to answer. We're with LPL Financial. They're the biggest independent broker-dealer in the country, according to a lot of stats and surveys. We're 16,000 reps strong across the United States, which I love. And they're our custodian, right? Your assets are with LPL Financial. They're not in a Guarino wealth management bank account. And that's really something I want to drive home to people, because if I just met an independent advisor, I'd be like, where the heck is my money going to go? Right? So and that's what's great about LPL is they're quiet in the background, but they're big and they're strong and they're deep. Which gives me a lot of confidence being able to tell somebody your stuff isn't in my bank account. It's with the biggest independent broker dealer that there is. You have account view, you have all these wonderful things that you can see your account online. I would hate it if I forgot to address that and you go home thinking like, well, I guess I got to write Mike a check. No, you write LPL Financial a check. So that's important to know. Very important.
Yeah, absolutely. It goes right back to that trust thing, right? Relationship
exactly.
thing. That's fantastic. Yes. All right, our last question in this game of role play.
Yes.
Ready? And everybody wants to know about taxes, so here we go. Mike, what kind of tax hit do I face if I invest with you?
Taxes? Who pays taxes? No, I'm kidding.
Everyone. That's the safe answer, Mike. Everybody pays their fair share every time.
Yeah. So that's a great question, and it's kind of depends on the types of accounts we're opening, right? If someone's investing IRA money, you're not paying any taxes on any investments in the IRA account. The only time you pay money in an IRA is when you take money out. Remember, you put money into an IRA, you got tax deferral. I'm air quoting that, tax deferral. It means that year that you put the money in the IRA, you did not pay taxes on it. You deferred the tax on it. Now it comes time later in life, ideally, that you start taking money out of your IRA. It's taxed as ordinary income to you. The money that you pull out of your IRA is taxed like income. So if I'm retired and I don't have Social Security or pensions or anything else paying me, and I go to Mike Guarino and I get $10,000 out of my IRA and I'm 65 years old, that $10,000 is ordinary income that year. So I will pay taxes on that. So that's IRAs. That's how they work. Now, a lot of folks have non-IRA accounts with us here. And that's where we have to be really careful with gains in the portfolio, because gains can be taxable. They can be either short-term capital gains or long-term capital gains. A short-term capital gain is if I own an investment for less than a year, make money on it, and I sell it, that gain is now taxable as ordinary income. Just like we said with the IRA, it's like if you just earned it, it's tacked on to what you earned that year. If you own it for longer than a year and sell that investment with a profit longer than a year, depending on your income and a couple other factors, you're going to pay what's called a long-term capital gains tax. And what a long-term capital gains tax is, and again, it depends on income levels, what your income was that year. A long-term capital gains tax is either 0%, 15%, or 20% of the gain in most cases. So that's where you have to be careful. That's why when we started, I said we've been busy pairing off losses and gains all year.
Yeah.
That's what we do, and a good advisor will be doing that for their clients, because what can you do if you have a loss in investment A and an equal gain in investment B, and you sell both of those investments, you pair off the loss and gain, and now you have the cash, the invested money on the sidelines to redeploy. So we're in that phase right now where we're actually reaching out to our clients after we've done this and saying, hey, we paired off this and this, and we have this much left over. Our thoughts are we want to put it in this, and this, Mr. Client, Mrs. Client. What do you think? And again, if the trust is there, and everything lines up correctly, the client's going to say, Mike, yeah, we like that. Just do it. We trust you. So we would do that. Really important. And that's where I think an advisor can really show their stuff. If they're paying attention to taxes, that's one of the biggest concerns I get working with corporate executives is they want to make sure, because they're getting hammered on taxes, they want to make sure that they're not paying more than their fair share of taxes. And techniques like I just mentioned, that's just one of them. There's many more. I wrote it in my ebook. But, that's one of the things that we can do to try to soften the blow is just, good pairing of gains and losses. We call it tax harvesting. Very, very, very important and very different from how IRAs are managed.
Yeah. Yeah, absolutely. Well, that's the 10 questions. And that's,
Wow.
it's been incredibly informative. But there's always this one other issue, and that is it can be intimidating to talk to a financial advisor or anybody. People don't like going to the doctor, right, to talk about problems or things. They don't like to go to the mechanic to talk about what's going on with their car. It can be intimidating to ask these questions. So do you have some advice, tips, tricks, something to help the folks out that will help them ask these questions? Because it is important to ask them.
Yeah, to be 100% forthcoming, like I rarely have people come in with pages of questions. I've had it. It has happened. And my first question is, where did you get those? And they'll be like, oh, I got it from so-and-so's website. I'm like, great. So we'll sit there and we'll go through the Q&A. But my one tip would be, just trust your gut. If you're going to work with a financial professional, ask for references. Ask your friends what their experience has been like with the person that they use. That goes a long way because, if you're just walking into it, the first person or first couple of people you meet may not be the right fit. But if you go in with someone referring you in there, which is basically how we get most of our clients, they get a feeling for who you are already because the person referring will tell you how they are, how I am already. Oh, you're like Mike because blah, blah, blah. The office looks like this. This is what he's going to talk about. So really depends on how they come through the door. The bottom line is, and you said it earlier, Eric, you have to have that trust, and you have to have that belief and that feeling that this person's sitting on the same side of the table for you and that they're capable with, their intelligence, with their portfolio management, with their designations, in their fiduciary capacity. You got to have that feeling that this guy or gal gets it. They understand me. They're going to do right by me. And again, trust is something you build over time. But again, you want that first step of trust on the client's behalf. If it doesn't feel right, do yourself a favor. Say, listen, that was a great meeting. I need some time to think about it, and go interview other advisors. You got to find the right fit, just like anything else. I've gone through, I can't tell you how many accountants. Just because, they're doing their thing, I get it, but I like a dialogue. I'm like my own client. I want to know a couple times a year what you think is going on, And if I'm not getting that feedback, I feel lost. And that's the one thing we try to bring to light. Again, we talked about modalities and communicating with people. We feel we can't over-communicate enough with our clients. And that's one thing we always pride ourselves on is our ability to call them, email them, reach out to them, and make sure that they understand what their portfolio looks like, what's going on. And again, it's taken time to get there, but it's the best thing when you have it there.
Yeah, absolutely. All right. Well, like we said, this is the second of a 2-part series. So if you haven't heard the first one, go back and listen to that. And if you're new to the podcast, there's one more thing. Mike, would you please take a long look into that crystal ball of yours? I mean, this is the perfect time of year to do it.
Cold. I see cold.
Dude, that's a snow globe.
Oh, get the other one. Hang on. Can we do it again?
Yeah, absolutely. Shake the other one. Jeez.
All right. Let's see. Okay. I see trees with gifts.
Nice.
So what'd you ask for Christmas, Eric?
To lose weight. Not really. We're asking for safety, I think, this year, because we're getting together with just a couple people, a couple family members that are, not long for this earth, if you will. And, they've been very safe. We've been very safe. And it's just mainly, two people that we want to really see. And so we're going to spend a little time with them. But we're just asking for safety for everybody, because it's just...
That's great.
We need it this year, right?
Yeah. And we spoke about the video that I did, the guitar solo thing. So just a shameless plug. I'll let you plug me, because I hate plugging me. But the reason I did that, and you can tell everybody what it is in a second. But the reason that I did that was because I know it's been a crummy year, and I know, like, my mom, she's 78 years old, super freaked out about COVID. So, like, the dynamics of the relationship changed. Like, I can't see her on her birthday. I can't see her for Thanksgiving. I can't see her for Christmas because she's freaked out about it. And I understand that. And it's just changed the dynamic so much that since 2020 was such a crummy year, I felt it incumbent upon me to just, get my message out, my music video out, and I wanted to share. And the biggest blessing has been, Eric, that people come back and say, hey, it put a smile on my face. Hey, thanks so much. That put me in the spirit. Those kind of things are priceless. And I hate to sound cheesy, and I'm going to risk sounding cheesy right now, but that was my gift to give to everybody that's willing to listen to it, because that's the exact response that I wanted.
Yeah. And it was fantastic. For those that are listening, it was a beautiful video. Mike just jams on his guitar, and Oh Holy Night, if I'm not mistaken, right?
That's right.
And so you did this huge guitar solo, and I saw it on LinkedIn. I don't know if you posted it anywhere else, but that's where I saw it. Do you have it anywhere else?
I have it on LinkedIn. I have it on Facebook. I think that's just the two media channels that I put it on. Yeah.
Nice. Yeah.
So if you go to Guarino Wealth, you search up Guarino Wealth or search up Mike Guarino, in Denville, New Jersey, you'll see the video out there on LinkedIn. And if you want to see Guarino Wealth on Facebook, it's on there too. So it's just, I can't tell you how good it made me feel when I read the responses. So I'm super pumped about that. And you and everyone there had some really kind words too, Eric. So I just wanted to say thank you for that.
Oh, heck yeah. Well, thank you for putting that out there, because that is by far my favorite carol to sing. I don't play, but maybe one of these days you and I need to do some sort of jam session with that. So
that'd be great, man.
That would be fantastic. All right. Well, Mike, again, thank you so much for your time. Happy holidays. Stay safe, stay sane, and we'll see you next year with more great information.
Thanks for everything, Eric. I appreciate it.
You bet. And of course, our last thank you goes to you, the listening audience. We wish the same things for you. Happy holidays, safety, and hopefully being able to connect with family and friends soon. Soon would be good, obviously, but we want to be safe in that. So again, thank you so much for tuning in and listening to the Rewire and Retire podcast with Mike Guarino. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Mike comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thanks for listening today. For everyone at Guarino Wealth Management, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for joining us on the Rewire and Retire podcast. If you want to learn more about how we can help troubleshoot your financial and retirement strategies, click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Guarino Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Investing involves risk, including loss of principal. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA/SIPC.